Okay, let's get back to the top story. The central bank interest rate decision. What's the perspectives from the investment community? Let's bring in Tola Abimbola, who is an investment analyst at Afrinvest. Afrinvest is one of Nigeria's licensed investment and research firm. Tola, good morning to you.
Good morning, Boston.
Okay, we appreciate your time. Okay, what's the perspectives from you folks in Afrinvest from an investment point of view about yesterday's massive haircut in policy rates and the CR?
Hi, Boston. Please, can you come again?
Yeah, the question was, what perspectives from you investment analysts in Afrinvest concerning yesterday's interest rate and CRR decision by the central bank from an investment point of view?
The key takeaway is both are going to come for manufacturing companies as well as for the government. If the government can borrow at a cheaper rate, that would go spending on infrastructure and could probably replace the economy. And for the manufacturers as well, if they could get lending rate at a very cheaper cost, that will also reduce their finance expenses, which will pass down to their bottom line. But overall, it's more of a trade-off. Going to the meeting yesterday, this was based on two decisions: to ease monetary policy further, to support domestic growth, but at the cost of what? At the cost of further external sector instability. And the other option is to tighten further, to reduce the external sector prices, and perhaps, that may stifle domestic growth. But the CBN opted to ease monetary policy further. And in the medium term, what we could see is that if money supply grows significantly due to credit expansion by banks as a result of the lower reserve requirement and the lower benchmark interest rate, we could start seeing additional pressure on the naira in the foreign exchange market. And the CBN has remained resolute in its administrative policies in the FX market. So a lot of this demand probably shifts to the parallel market. So that could probably increase the spread between the interbank FX rate and the BDC, or rather parallel market segment rate. So of course, it's a mixed bag. There are the positive sides of it, but looking at the medium-term outlook, there could be additional pressure in the foreign exchange market, and with less than $31 billion in external reserves and the bearish outlook for oil, I mean, we're going to need a miracle to avoid a further devaluation of the currency in future.
Tola, in the last couple of hours, since the end of yesterday till the moment we're speaking live now on television, what has been the discussions from your investors, from your clients, calling from within and outside Nigeria, about what they should do with investments in Nigerian financial and other assets as this new interest rate regime kicks in?
For most investors, most of them are trying to go short on banking stocks now. It's going to take some level of time before banks adjust to the new system. I mean, it's been 5 years of banking on cheap income lines, relying on investment in fixed income securities to bolster interest income. But with the reduction in interest rates now, we should see lower interbank rates and lower yields in the fixed income market. And of course, so banks would need to probably channel more of their funds into the real sector in order to earn additional, to earn a higher spread and bolster their net interest margin. But this won't happen overnight, apparently. There are lots of credit risk banks are facing, and they will not jettison their due diligence on loans just to satisfy investors in terms of granting more loans. So, of course, for most investors now, they're going to try and go short on banking stocks and see how they're going to adjust to the system. But for the industrial goods segment, I mean, most people are now expecting government to spend more money in fiscal 2016 on infrastructure. So most people are trying to stay to go long on cement companies, on building and construction companies. And of course, with the lower interbank rate and the lower use of the fixed income market, most investors are going to try and look at their risk adjusted return and think probably it's time to start looking at opportunities in the equities market.
Ah, that's very enlightening. But hold on a second. How does it all affect you guys who are fund managers? Yeah, the question was, how does this interest rate cuts impact on you fund managers?
Well, for money managers, for asset managers in Nigeria, from pension funds to insurance companies, for them to achieve their return objective is going to be much more difficult now. Most rely on fixed income investments in order to earn very good interest income and boost out their earnings reserve. So certainly, for most of the pension funds now, they would need to start looking at how they can be much more, be less conservative in terms of the allocation of their funds in order to improve on their income and their revenue. And also for insurance companies and other money managers, they would also be more willing to take more risk in the equities market and probably some other alternative investments in order to achieve their risk return objective. Definitely, you cannot rely on a 5% yield in the fixed income market if you want to return very attractive amount to your clients.
Tola, so this is the time you research analysts will be scratching your head. Or perhaps your job has been made out for you, because now when your next investment report is out, we know what it will likely contain: manufacturing, solid minerals, power, and agriculture.
We are reviewing our models. I mean, for most of the banking stocks now, we are expecting them to earn lower return on their investment securities, and we are placing a number of them under review to try and see how they would probably adjust to the new system in the economy.
Very interesting. So this is an adjustment all around for every one of us, perhaps with the exception of those of us who are on television. Tola, thank you very much for your time.
Yeah, thank you very much, Boasen.
We appreciate that. Let's go make all those adjustments.